But didn't record yesterday. I was moving around quite a bit, looking at a bunch of houses that have got some things that are getting kind of held up for some of the investors I'm working with. So, and they weren't quite under up to date on where they were with those homes, with those who are working on them, because there's just crew management issues and a few things. So I decided, hey, I'm not far. I'll go check it out. So I drove over 3, 4 hours away from where I am here to go take a look at that and get good pictures of everything and send that out to people, get them an understanding of where everything sits now. Um, I get when things get out of hand. I understand that. I think we all need to pitch in and jump in and help each other out and make sure we get things done. Abandoning folks, not communicating with them, or being a third party who is helping them with the deal, but then abandoning them, not helping them with it. That to me is not cool. I think we need to all jump in and help each other out and try and make everybody successful in what they're doing. There is plenty of room for everybody to make each other successful and not think that there's some sort of potential loser in every transaction. Like everybody can win in this. And speaking of people who can win in this, I talked about some deals that hit my desk. There's some people winning monster on those deals. They took them and they're pretty significant. A couple more have come about. So we're looking at basically being able to pick up a house. And I don't have any of the numbers in front of me. I'm getting updated numbers on some new ones. Being able to pick up a property by the time it's done, rehab, ready to go, ready to rent. When you're done with everything and you got that long-term leverage on it, you really only have about 10, 12, 14% in the deal, with the way some of these stacked up. So when you do your numbers, we've done before about, hey, if you put 20% down on a $200,000 house, you've got 40,000 invested, and that means you have a $160,000 loan. Even if you have 10,000 in cost, you're at now 50,000 invested in the deal. If a person is paying off your mortgage for you, and that's all you had was just the tenant paying off the mortgage, they're paying off the $160,000 over 30 years, which is equal to $5,333 a year, averaged over 30 years. Divide that into your 50,000 you invested, which is 20% down plus 10,000 in cost, if it was that expensive, and you're looking at a 10.6% return on your money. And what if the property only appreciated at 2.5% per year? $200,000 house appreciating at 2.5% per year. You can pause here and do the numbers. That's $5,000 a year. That's another 10% on your money. That right there, investing money right there into that asset that's just paying itself off because of the tenant and appreciating 2.5% per year, you're at 20.6% annual growth on your investment. There are some people who say, well, what about a lost opportunity cost? What opportunities are out there that are going to present that kind of a return consistently? Even if you don't make any cash flow, that's a significant return on your investment for when you sell. And yes, there is some cost to sell, but if you're talking about 8, 10, 12, 14 years down the road, those costs are pretty minimal compared to what you made. Those costs are less than that one year's worth of return. So consider that. And if I've got people getting away with 12 and 14% left in the deal, do the math on that. It becomes pretty significant at that point because there's less invested. Cut that in half. That right there, you're talking about 20 plus another 10. You're looking at 25% invested in this deal. And if you're knocking it down to 14, that's a significant growth on that. So I'll let you play with those numbers. And if you want to take some time to play with the numbers with me, we'll talk about it. I don't leave you flapping in the breeze to calculate this out. And there's deals out there right now. They're coming to me saying, hey, you have anybody interested in something like this? I'd love to connect you up so you guys can decide for yourself. I'm not going to push you into something. You decide for you, but I've got people coming to me with opportunity that I can present to you as a client of mine because of how we math it out. It's not everybody out there just going to say, hey, what's your cash on cash return? Any fool can ask that question. You need to really get deep into the numbers to understand how to become successful as an investor. So today is the 2nd of July. Again, I was going to try and get out yesterday, but was not able to because of where I was at, what I was doing. What we've had this week, we've had Chicago PMI came out a little bit lower than the previous reading. Construction spending is down. Now, that could contribute also to what's going on with people with their delays and rehabs and things like that. You still have the asset, still stick with the asset. It's still a good move on that. Who was it that said Charlie Munger gave him advice, never sell a house? Well, if you're supposed to never sell a house, you also buy deals that are houses out there. Now, you can't just go out there and buy crazy, but call me. We'll talk about the ones you should be looking at. Again, just look at them. Your decision. You're the CEO of your investment firm, real estate investment business, if you will. ISM manufacturing index is up. So manufacturing's gone up a little bit. Job openings are up. So people are trying to get people hired. We need people to work. Mortgage applications, those have gone up a bit from the last reading. ADP employment change, that's interesting. That dropped a lot. Dropped significantly compared to what they expected, right? So and it's a big swing from what it was previous. So that should have moved our bonds very, very positive. Crude inventories today are up significantly from what they were coming in the week. At the end of the week, July 3rd, or see tomorrow is going to be non-farm payrolls, unemployment rate, average work week, initial claims, and continuing claims. So a lot more employment data. But what's interesting is we had the ADP reading last time, which did not go along with the non-farm and payrolls and the average work week and hourly earnings and initial claims and continuing claims. So that might be why the market is paused. So let's take a look at what we have here so you guys can see what I'm talking about as far as what the market is doing and what I think it probably should have done. Jobs have a way of moving the bonds and moving the bonds significantly. And if you remember back when, let's go all the way back here, when we had the Biden administration talking about how awesome they were, amazing job creators, all that, and they were touting it like crazy. And then the actual numbers came out about here, and then we saw, bam, it rammed up. They're saying job creation, the market's doing amazing. We're doing a kick-ass job. We're the greatest administrations ever walked the planet. They're actually just recalculating people going back to work after COVID. You get back to October 2023, it reversed because they started saying there's really not very many people going to work. They're counting government jobs, they're counting return from COVID jobs, not real job creation. When we started to see that and the real numbers happening, the bonds reversed, stocks reversed, bonds started to take off. And where did they hit? They hit that barrier we've been talking about, which is the line established when they announced quantitative easing. Then we end up kind of writing this whole thing out, other news pushing things around. But again, we hit that quantitative easing line, hit the end of that trading day, pushed back, pushed up again, pushed back down. We wrote a channel down. I don't have these channels marked. I'll have to remark them because this is not saving it the way it's supposed to and show me current data. And then we had another channel we wrote down. But look what we're doing. It's following this pattern. If you see the pattern that we're following here, hammer it, hammer it. So we go up to the top, we come down. Go up to the bottom of this channel, these yellow lines here, come down, hit the top of it, come down. We hit the bottom of it, came down. We're trying. And this is where we'll zoom in on right here. We're trying today with the ADP information. It wanted to take off, wanted to go positive, but it pulled back. But I think it's kind of wait till tomorrow and see what happens. But it's possible if we rock it up here and we come back down. I don't know if we're going to follow that pattern continually, but we just know that this is a significant barrier. This area here is quite the barrier from 100.54, that's the price of it, to 101.49. That's a monster barrier. We're having a hard time getting above that. There's not a lot of information that would make it to where traders want to go into this any deeper into the mortgage-backed securities. So people say, hey, well, the Fed needs to drop the rate. That's not going to help. People need to create money out of thin air and throw it in there to push it into those bonds to give more money for us to lend. That's following the conventional loans. That doesn't follow the DSCR loan. I do a lot of DSCR these days. In fact, an enormous amount of DSCR, helping people get financing 30-year fixed to your LLC. It's dang near the holy grail, guys. If there's you begging for this for years, and now we have it. So call me about it. Let me show you how to do that. Build it as a business, and it becomes unlimited of what you can do. It can be really significant. We'll talk a little bit more about that on Friday, but as far as what we're doing with this, the bonds are going to react with respect to how it's going to push the rates for conventional, not for DSCR. DSCR is good as a private label security. It's all a matter of funds that are available at that time. So anybody who thinks the Fed's going to push around DSCR rates, it's not what's happening. It's a matter of where they're getting the money, how much money is available, and how fast they're using it. That's really what it boils down to. If you have questions, get a hold of me, especially if you want to look at some of these deals that are hitting my desk. You go to info@aaronchapman.com. You can text me 602-291-3357. Just go to aaronchapman.com. Click on that connect up. Info@aaronchapman.com is my email address. You can get a hold of me at any time. Appreciate you guys.